Okay, hi there, welcome back to another in our series of A-level economics key diagrams. So we work our way through some key diagrams that could help you get top analysis in your papers. And of course, the better the analysis, the stronger will be your evaluation. Let's take a look at advertising and business profits. Well, advertising and marketing, obviously a key form of non-price competition, especially in perfectly competitive markets such as monopoly and oligopoly. And many businesses use this to reinforce their market share, to protect their market position, if you like, and also to make demand for their products less price elastic, to reduce the coefficient of price elasticity of demand. So they do this by using successful smart marketing to increase the brand loyalty that people have, the attachment that customers have to products. Very interesting. If you look at the total advertising at the top end, these were the biggest advertisers in the UK in 2020. Of course, a year that was dominated by the pandemic. Her Majesty's government, not surprisingly, was the biggest advertiser with all the health warnings and campaigns in place at the time. But then look at the companies that lie a little bit just beneath the surface. Unilever, Sky, Procter & Gamble, McDonald's, Tesco, Reckitt Benckiser, L'Oreal. All of these businesses essentially operating in oligopolistic industries. And that's a little reminder of the key importance of advertising in those kind of market structures. So let's just work our way in terms of how advertising might impact on profits through changes in demand and costs. I'm going to be using cost and revenue curve analysis, top level analysis. Here's an initial output where profit maximizing firm is producing an output Q1 where MC meets MR. And the price they're charging is P1, the average cost is AC1. So the supernormal profits at this output level equal the area P1, A, B, AC1. There they are. There are the supernormal profits. And that's a good position for the firm to be in. They're making a good profit. The price they're charging is well above cost. Now, successful advertising shifts out the demand curve, AR, and also the marginal revenue curve. So if you get a question on advertising, don't forget, please, that advertising, if it changes demand, will shift out both the average and the marginal revenue curve. And this allows the firms to sell more product at higher prices. Strong brand loyalty reduces the coefficient of price elasticity of demand, which in turn allows firms to sell at a higher profit margin. So here's our shift in AR from AR to AR2. There's a shift in MR. I've relabeled it from MR1 to MR2. Consequence of this is that there is a new profit maximizing output at Q2. So high demand means that firms will expand production. And of course, it now allows them to move up to the demand curve and sell at a higher price P2. Now, there's been a little bit of a change in cost. I'm going to assume that cost is more or less the same at AC1. But of course, the higher price and increased output causes an increase in total profits, shown by the green shaded area. So in theory, advertising can lead to higher supernormal profits. However, don't forget that advertising is also a cost. And for most purposes, we treat marketing as a fixed cost. So, for example, you might spend £50,000 on a TV or internet advertising campaign. That's got to be paid regardless of the output. So essentially, advertising can be treated as a fixed cost. Now, a rise or an increase in fixed costs causes average total cost to shift upwards, but there's no change in marginal cost because marginal cost is only affected by variable costs. So here's the effect on the diagram. Gosh, this is getting a little complicated. Fantastic diagram. Average cost increases from AC1 to AC2, but there's no change in marginal cost. That's still MC1. Therefore, there is no change in the profit maximizing output. It's still Q2. But can you see here that the profit, that was the original profit before the rising costs, shown in green, but after the rising cost, that profit just shades down a little bit and increases, falls to the green shaded area once again. So really the impact of advertising on total profit depends on the success, the cost effectiveness of advertising. Again, thinking about these big businesses, Sky, obviously major competition with other TV subscription services and streaming services. They spend a huge amount on advertising. In the UK, over £3 million a week in 2019, although they did cut back, of course, during the 2020, the year of the pandemic. And here's McDonald's. We all love a Mackie D, maybe. McDonald's, one of the biggest advertiser spenders in the UK. Again, over £3 million in 2019, but they cut right back again in the pandemic. Really good example here of how businesses might try to reduce their fixed costs during a recession. Now, many firms, of course, make smart use of digital marketing. So if you can get some viral adverts going, if you can use social influencers on social media, you can often achieve pretty impressive results in terms of sales and things without having to spend big on advertising. So there we go. Hopefully this was a useful both application and analysis showing the effect of advertising spend on business profits. Thanks for joining in. Stay safe, stay happy. See you sometime soon.